Welcome everyone to the April 2025 ClearVista Financial Perspectives. This is our monthly market update where we kind of discover or discuss a lot of the different things that are going in the markets, policy impacts and things. And we're getting into a big discussion today about trade and tariffs and the Federal Reserve, and we'll look at the indexes as usual. Here with me today, as always, is Jesse Hamilton, one of our financial advisors.
Hey, everybody.
Welcome. And we've got a beefy agenda for today. So
Yes,
let's go ahead and jump in and talk about that, and we'll get started. As always, remember you can send your questions to us at 254-282-0495. That's our text line. And you can text us to see what questions you might have. We'll try to answer those live in the webinar today. And if we don't get a chance, we'll get back to you personally within 24 hours of that. You can also send us an email at info@clearvistafinancial.com or that text line 254-282-0495.
Yeah, and same welcome an invitation goes to those listening later via recording. Shoot us a text if you have any questions about what we're talking about. But today we're going to focus on the first quarter of 2025. We have made it through the first quarter, and it's a little bit of a bumpy ride, but let's get into the details. First, looking at our stock market indexes. The first one here is, as usual, the S&P 500, and this is a candle chart. As a refresher, each candle here represents a day, and a green candle is a positive day, a red candle is a negative day. And you can see the price action throughout the day on the stem or the wick of the candle there. And the S&P 500 is our large cap weighted index in the United States. So big companies here. The S&P 500 was down 4.69% for the first quarter of this year. And of course, that means from December 31st last year to March 31st of this year. And peak to trough, you can kind of see there right in the middle of the chart, there's a green bar. That's the high of the year. And then all the way down to the trough, that was 10.72%. So that's officially a correction territory.
Yeah, and that matches the kind of the longer term trend. We've had this kind of get close to this twice in the last 90 days. December 19th was the previous high in the S&P 500, and we are seeing that near there now. That was around the time that the Federal Reserve had their December meeting announcing that they were not going to cut interest rates as quickly as they originally thought.
Yeah, they basically changed their mind on their trajectory, but we'll talk about this in a minute. A 10% swing in an index like the S&P 500 is actually a normal and even a healthy thing. We expect to see a couple times per year. I know it doesn't feel good to be the investor on this side of the things, but it's normal.
Yeah, and that's just the market index. That's not all indices and so forth that went down that much. That's primarily large cap companies. Now, if you have a 401k and you're not getting some assistance from us, you probably are heavy into those large caps. So you may have experienced a larger decline the first quarter than you're expecting, but we can certainly help you with that.
So here's the NASDAQ, which is our tech heavy, also cap weighted index. It does not include financial companies, heavy on the technology sector, but it's actually including more and more sectors as time goes on. This was minus 10.42 for the quarter. So the actual price movement close to close for the quarter was over 10%. And then the peak to trough on that was minus 16.22%. As we expect, it tends to behave like the S&P, but more volatile. And for the first time in quite a while, the tech sector was struggling more than other areas of the stock market. Here's the Russell 2000, our small cap index. These are smaller companies in the US. This was minus 9.72% for the quarter and 15.26% peak to trough. And then lastly, we'll talk about some long-term bonds here with, I wrote LT Treasury, that means long-term Treasury. And this, the long-term Treasury bond index was actually positive 4.24% for the first quarter. And if you look at the trough to peak, which is the opposite of what we've been doing, it's actually a little over 9%. But unfortunately, this index bounced or hit resistance several times up against the 200-day moving average, which is our long-term indicator of strength. And it tried once there in February to hit it, and then it tried again in March, and it's bumped up on that line a few times and has not been able to cross above it.
Right. And that may have changed today with the tariffs that we'll talk about in just a moment. But we haven't seen that break out because that would signal kind of not of an end, but a change in the trend of long-term treasuries that really in the last few years have ended a 40-year bull market in treasury bonds.
So then here's our moderate index. And I'll just note here that this is for somebody who maybe has an equal portion of stocks and bonds in a portfolio. It was actually pretty much flat for the quarter because the stocks were suffering and the bonds were rising. And so not a whole lot of action here. It did swing quite a bit there at the end of February, but this is kind of the combination of the two asset classes we've been talking about, winners and losers, and this is just moving sideways right now.
Yeah, next time we should put the long-term treasury, very long time frame out, and you can see how much the treasuries are down for some time,
Right.
and that impacts the moderate index. Here's our disclosures.
Read them carefully.
Thank you, Jesse.
Let's talk about volatility for a minute. Seasonally, March is an extremely volatile time. You can see that peak in this chart right in front of where the red arrow is pointing. It's actually the most volatile time of the year. And then seasonally, we move into April, May, June, July, August, all through the summer, and volatility is reduced. That might be different this year. It might be the same. This is no prediction of where the price of this index will go. It's just simply an indication of how much the price is changing historically over time. So we are supposed to be going into a lower volatility season. Again, this has been in our slides for the past few months. I just wanted to note again that the S&P 500 is still a top-heavy index where the largest companies are carrying the most weight, even though they have been struggling over the past month or so as far as the indexes go, but they still make up a huge portion of the S&P and the NASDAQ too, really. And that has a huge impact on the way that it behaves.
Yeah.
So here's an interesting chart that shows the S&P 500. And I apologize if it's a little bit small. Maybe you can zoom in on your screen there. But the S&P 500 represents stocks, and the Bloomberg Aggregate Index represents bonds. And the stocks are in dark blue, and the bonds are in orangish yellow. And you can see over the past 35 years kind of what's happened. Notice 2022, where we've talked about both bars were negative and it's an extremely rare occurrence when that happens. And there's a dotted line. You probably won't even be able to see it at that 12% mark, which is the S&P's average over this time. But we don't want to forget about 2008, which is that bar right there in the middle that goes all the way down over 40%, where stocks suffered a lot. So historically, rebounds in 2020 and 2022 show that markets do recover when downturns happen. And of course, this is just an example of long-term investing strategy, that success isn't about timing which bar is the highest and avoiding which bar is the lowest. It's not about picking winners. It's about building a portfolio designed with your long-term goals in mind.
Right.
This shows it right here, that if you had just stuck it out for 35 years, you can participate in those market swings and have a long-term strategy. That's my point here.
So it's really it reminds me of the old adage of it's not about timing the market, it's about your time in the market.
Exactly. So that's my point. So we'll take a pause here for a second and we'll get into kind of the more current event side of things, which I'm sure you all, that's why a lot of you tuned in here. Again, shoot us a text 254-282-0495. Let's shift gears here for a second though, and beyond the indexes and beyond what bonds and stocks are doing, let's talk about the economy and the interest rate environment. And then, of course, at the end here, we will do a bit of a deep dive on tariffs.
Okay.
So what happened with the Fed in March?
Well, the Fed did meet again, and they're still taking a kind of a wait and see approach to this. Their view is that economic activity continues to expand at a solid pace. Unemployment still low, labor market conditions are stable, and that's one of their mandates. So you remember the Federal Reserve has a dual mandate, really. They aim for maximum employment, which really full employment is considered 4%. And I think we'll get unemployment numbers tomorrow.
So full employment would be the other side of that, the 96% employed. So
yeah, basically. Yeah, basically that's what it means. And 2% inflation. Now this 2% inflation thing is actually kind of something that was only adopted um, in really the last couple of decades, because historically inflation's always been about 2.6% or higher. And for some reason during the low interest rate days, the Fed adopted this policy of keeping everything at 2%. Well, they're not doing a very good job of keeping inflation's at 2%. We saw it tick up in March.
We'll show you some numbers here in a minute about what it's actually been compared to that 2%.
Exactly. So there's this dual mandate. And then they decided to maintain the federal funds overnight rate. They're basically going back to saying, hey, we're not going to make predictions. We're just going to make decisions based on data and looking at the overall risk. So the Fed's still going to continue reducing holdings of treasury bonds and agency securities. They're going to still continue to unwind the balance sheet, but they're going to slow the pace at which they were doing that.
And of course, Jerome Powell and the official statement and the comments and questions afterward maybe had a slight inclination of uncertainty when it comes to, the tariff situation and economic data. But, when it comes to the way he talks, this much little pinch of uncertainty turns into massive headlines. So we saw that shift in tone. Doesn't necessarily mean that he has a negative outlook. In fact, he has a very positive outlook, but maybe just a marginal shift in the tone that he's talking.
Well, let's kind of look at the rates and how they've gone over the last couple of years. And you can see here, going back to 2022, we had a very rapid rise in interest rates as inflation started to take off. There were a number of different reasons around that. The biggest problem, though, is really the money supply. The federal government increased the money supply in the United States dramatically with all the COVID incentives and everything else. And that caused prices one of the factors that caused prices to go up so quickly. So this is the projected Fed funds rate when you look at it from going forward through 25 and 26. They updated these things, and now they're basically saying that perhaps long-term overnight Fed funds rates will be in the low threes by the end of 2026. So right now we're in this 4.25 range right now, but they're predicting that. But the pace at which they are slowing that pace has changed a little bit.
So presumably the green line is the FOMC, that's the dot plot.
Yeah.
So these are just the voting members predicting the future. That's all it is. It's just a prediction. And then the red line is, I think it's from Bloomberg on what they think the market's pricing in. You can see that the market's a little bit not as optimistic as the FOMC in green. The market doesn't see really this thing dropping below 4% for quite a while.
And that's probably some of the reason for the volatility that we've seen since mid-December is the market was originally expecting back in the fall that rates would be much lower by this time, and they're not getting that. So there's no guarantees. These are just predictions, and we often find that the Fed economists are often wrong.
I showed this chart, but I updated it for kind of a flat portion because they have not done any cuts in the last two meetings. But you can see the quick rise compared to the small amount of, I guess, a total of 1% of cuts last year, and really how little of an effect it's having on the overall uh, pattern and scale of what we're dealing with.
Yeah. This is the basically the yield curve, which plots the current rates as of the end of March for short-term treasuries all the way out to 30-year bonds. And we can see here that the yield curve has been uninverting gradually.
Yes.
We still have high short-term rates. Now this is gonna all these yields are actually dropping today with the tariff announcement yesterday. Today is what, April 2nd, 3rd? April 3rd, and we'll see rates dropping, but still the curve is beginning to uninvert, if you will.
We want to see the left side of the chart on the short-term low and the long-term high. We're getting there, but you can see there's still a really big dip on the horseshoe there in the middle, right around
The 2 and 10 year.
2 to 10 year range. But it's actually the 2 to 4 year range where it's the true dip there. So it's working, but it's going to take time.
And that usually causes volatility in the market when that does happen. So
historically,
we're expecting this.
I saw this chart, and I know it's small and you might not understand what's going on here, but I liked it because so many people right now are saying, let's just hide out in cash. We'll get some good yield on our CDs and we'll wait for this thing to calm down. And the yellow line here is the after inflation return of sitting in a 6-month CD. And you can see that over in the 90s into the 2000s, up to 2010, it was actually in slight positive to do that. That made sense. You're actually outpacing inflation, not losing purchasing power. But look what happened in the last decade.
Yeah, your purchasing power is declining. And so this is kind of the impact of inflation and the hidden cost of cash. People feel safe when they're holding cash in their CDs or perhaps in their savings account, but they're losing purchasing power. And that's what really matters the most, Jesse, is what can I buy with the dollars that I have saved? It's not the nominal dollar amount. Now, you may be nervous about the day in the news because it's all over the news. It's a bad day in the market.
Yeah.
But it's not a cataclysmic event that like the media will try to portray to you.
Yeah, if you pull up Bloomberg right now, the entire website is one big headline.
Yeah, and that's what gets people to watch, is because it's like, oh my goodness, that was actually starting yesterday afternoon. They had these big headlines and banners on there, trying to get you to tune in because your portfolio is going to lose value today. But here's the thing: long-term wealth requires portfolio growth, not just preservation. And if you think that hiding in CDs or putting your money in cash is the safe way to go, you are being deceived in some ways because of the loss of purchasing power. And we'll talk about how that is impacted by inflation and different things in just a moment.
Cash has a very, very important piece in your financial plan, but over allocating to cash right now, this chart proves that it's actually a long-term, a poor decision.
And that will erode your wealth over time. Okay, let's talk about this a little bit. So Fed Chairman Jerome Powell famously said that he wanted inflation to average around 2% over time, even if that meant that you had to run hot for a little while. Well, mission accomplished and then some. In the last 5 years, the inflation has averaged around 3.7%. That includes the low years, some low years and high years. And over the last 10 years, that's above the Fed's target on both short-term and long-term horizons.
At 2.6.
At 2.6. Now, this means that the Federal Reserve's COVID-era money stimulus and the federal and the government, the Treasury, they may have overcorrected. Okay, and now any progress they've made bringing inflation down looks increasingly temporary.
Yeah.
So let's talk about tariffs, Jesse.
So let's clarify one thing here. Tariffs are not just about the tariffs, right? They can raise the price of certain goods, and we do expect that to happen if these remain in place. But they also reduce demand elsewhere, And in history, we've seen that this is a net effect of neutral.
Right. And the real issue here is a monetary issue. We have too much money in the system. And some of our economist friends at First Trust and other places like that have been talking about this for some time. The real issue is the money supply. Tariffs have their own issue or own tools that can be used. And I think there's a little bit of a misconception about tariffs, and we're going to talk about that in just a moment. But with government debt at record highs and markets hooked on low inflation rates, inflation, believe it or not, has some appeal to policymakers.
Yeah.
It reduces the real value of debt and creates the illusion of growth.
Yeah.
So, what's some of the market reactions? Well, gold has surged above $3,000 an ounce. That's a clear signal that investors are nervous about inflation and currency stability. I think if anything is coming out of the trade tariff little war that tariff or Trump is embarking on, is that you're going to have currency instability around the globe. People will be fleeing dollars instead of hoarding dollars. So the 10-year Treasury yield as of this morning, it was 4.01. It would be amazing to see that if that went below 4, even with those expected cuts, means long-term investors aren't buying the idea that inflation will be tamed anytime soon. So we look at some different things, a CAPM model. I won't get into the details, but it still shows that stocks are still overvalued at these levels. And in a true tightening cycle, we'd expect those valuations to reset.
But that's a normal process.
That's correct.
A healthy process.
That is a normal, healthy rebalancing standpoint, if you will. So, in other words, the bond market and the Fed aren't aligned. Bond investors, often referred to as vigilantes sometimes, are signaling concern over debt and inflation, not just growth.
And in a lot of ways, in very crude terms, it seems like the previous administration wanted us to feel wealthy and have money now for maybe the long term to hurt some, whether they saw that or not. And then the choices by Trump today are kind of a let's take the pain on now, and the long term will be a lot healthier and wealthier. And they're kind of opposing.
And Americans don't like pain.
No.
They don't see it, and they don't see the long term. We have mismanaged our economy for decades, and we are now paying the price of that. That is not gloom and doom. That does not mean a recession or anything. But what Trump is doing, or at least he's attempting to do, is to try to correct some of those things. But there will be some pain involved with that. We don't know how that's going to pan out in terms of the economy or the market.
And of course, if you look at Trump's mantras over his whole life, it's the art of the deal, right? It's negotiation. And we'll see how many of these do remain in place when companies either retaliate or code or negotiate with us. We'll just see what happens.
Jesse, let's talk about trade tariffs and things like that real quick.
So this chart shows the U.S. trade balance. This is pulled directly from the Wall Street Journal this morning if you want to go read that article yourself. But you can see the black line in the middle there is the total trade deficit. You can see it's declining over time. This is since 1980. And the line kind of dipped there in the early 2000s, and then it was stable. And then in the last maybe 10 years or so, you can see that it's been declining. There's also a increased goods deficit, and that just means that more goods are coming in than goods are going out. And if this trend continues, we're in deep trouble. And I think that's what the administration is realizing.
Well, and a lot of people don't understand tariffs and what they are. A tariff is basically a tax on a good coming into the United States. And the idea there is if it costs more to buy a good from another country, that Americans will be more likely to buy goods that are domestically made. Now, we saw this in the 1980s. When our 1970s go back, 1960s. LBJ was president at the time. And Toyota was, we put a tariff on Japanese cars coming into the United States. The end result of that tariff was that Toyota decided to actually start manufacturing their vehicles in the United States. It brought jobs to the U.S. It also shifted their manufacturing to the U.S. and now almost every Toyota is made in America. Well,
Yeah.
that are sold in America.
I mean, there are several fallacies going on and logistical nightmares happening when these companies are hit with 10, 20, 25% tariffs. You can't, if you're Ford, you can't just all of a sudden have a factory in New
Right.
Mexico.
That those take time to correct themselves, but they will. I think one of the things that before we move on, Jesse, I think one of the things that there's a misnomer out there. There's been a lot of reference in the media to the Smoot-Hawley Act of 1930 and
100 years
how
ago.
that, yeah, almost, yeah. I wasn't alive then, but I know people who were. Um, the Smoot-Hawley Act and its impact on the Great Depression. There's a lot of misinformation out there saying that the Smoot-Hawley Act actually caused the Great Depression, that the Smoot-Hawley Act caused if it didn't, then it caused inflation to go up, and that actually was not the case. The Smoot-Hawley Act came in well before the Depression started, and the country was already having decline before then. The original was introduced in the House in 1928. It didn't pass until 1930 because there was so much debate and delay with things, but that's not true that the Smoot-Hawley Act and tariffs caused the Great Depression.
Mhm.
Now, something that was different about our global economy then than it was now, and that is most countries were on the gold standard. All right. And so if you had to buy and sell goods, you maintain your currency by backing it up with gold, which meant if you had to pay more for U.S. goods, you had more gold going out. It actually, all that was happening during a deflationary time in the economy. And that exacerbated problems to some extent. We don't have those same things now. Yes, tariffs will cause inflationary pressures in the short run on goods that are imported. It'll cause some problems for goods that are exported, but all this should balance out. And Jesse, let's go into looking at the tariffs. This was on a
It,
poster yesterday,
and
and
Trump was so mad that he could only use the little one. He
yeah, I
brought this
mean,
giant one and he was like, I have to use this little one.
we had to put things on the big TV in our office and actually use my glasses to see what was going on. This may be a little bit hard to see, but the bottom line of the tariff announcement yesterday from President Trump was that we are going to at least meet others' country tariffs for our goods by about half. So, an example of China. Now, this is kind of a little bit confusing here, folks, because the chart says that the trade uh, tariffs charged to the U.S. and it incurs currency manipulation because a lot of people don't realize that large countries will manipulate the value of their currency to impact the cost of goods overseas in other
Mhm.
countries. And so I don't know how much of these figures are baked into the currency manipulation. I'm not really sure how they calculated that.
It's more of a political poster than an economic poster.
Yes, but you can kind of see here, there's certain countries like Vietnam charging 90% tariffs. And if you think, look at your tennis shoes that you're wearing, look at your t-shirt that you're wearing today, it probably was made in an East Asian country. There's a good chance that those things were made in those countries. You will see the cost of those goods go up temporarily.
There's Taiwan right below it.
Yep.
Almost all of the chips that are in all of our cars, phones, computers are made there.
So, but
And
you can see here, we're not necessarily matching all the tariffs of these other countries. We're going up to no more than really 50%. Cambodia, 97% tariff on these things. So it's really interesting to see this. Now, this was published yesterday. Who knows how this is going to play out? Because I imagine that the United States is having negotiations with these individual countries. The EU is really the only one that's negotiating in a block right now. And of course, everyone's threatening retaliation with their own tariffs. The difference is this time around is we're not going to cause a a global end of trade
Well, that's
like we
what
did during the Great Depression.
the articles like on all the news outlets this morning are calling it the beginning of deglobalization.
That's not the case at all. It should actually facilitate more globalization, in my opinion.
Hmm.
And I could be wrong with that, but we'll have to see how that pans out.
Here's a couple of examples of trade wars in the past. And we have some commentary here from our friends over at Kitsis, unrelated to this chart, but I thought that they would go along kind of well together as we face this political uncertainty and how the market reacts. The green line on the chart you're looking at is the S&P 500, and you can see all the different dots here of major trade events happening around the world.
Right. And once you go through a couple of those, I think those are kind of interesting there. But we can look at the going back to 2004. Most of these are with China. Um,
There's the 2009 US and China tire tariffs. I don't know what that is.
yeah, and textiles and apparel import restrictions. Because a lot of these we can just simply the countries can simply just restrict and say no, you can't. Like in Australia, Australia will not allow U.S. made beef to be sold in Australia. So these are just kind of interesting stuff here. Oftentimes, economic policies are controversial, and you're going to watch in the news and you're going to see all sorts of different things that are wrong with this or that on both sides of the aisle. It's very much a political conversation that we're having, and even in the business news outlets.
Mhm.
Um, I even read an article today that goes back to the Smoot-Hawley Act from 1930. It was the great grandchild of Senator Smoot, and she was a homemaker in Maryland, and she didn't like the tariffs, and she thought they were bad. What does that have to do with anything? She wasn't an economist. She wasn't studying this. She just remembers that her great grandfather was the author of one of these bills.
Mhm.
Folks, there's going to be a lot of misinformation out there. Be patient. Today in the market's not a great day at all. You will see this begin to normalize and regulate. And as they keep going forward with things, you're going to hear lots of news that'll cause bumps in the market or spikes in the market. It will take some time to work at this. So, and the reason for that all is markets don't like uncertainty, right, Jesse?
No, they don't. And of course, the recent policy changes, big investors, small investors, that causes a lot of anxiety. But really, the current volatility is driven by this uncertainty and not the underlying economic situation. And generally, historically, markets actually stabilize when we have this clarity. So yesterday we had this press conference, and the markets did not like it as they opened this morning, but they do tend to stabilize after we know the actual information. What is he going to do? That's when we see stabilization.
Because markets want to know what might happen. And so once they figure that out, investors will respond accordingly. Right now, there's just a lot of fear. And we're looking at the markets today, Jesse, about this. And, we look at it and, we think, oh my gosh, things are bad. But we look at this and there's different corrections and different things like that in the market. The we're still seeing those indices stay above what we kind of drew as a floor
Mm-hmm.
of support in the market. Yes, their portfolios pulling back probably
Probably, but not.
today.
I mean, I'm speaking on behalf of our clients. They're not necessarily as much as the indexes show, even if they are pulling back. And we don't have a crystal ball to magically allocate your portfolio, but we are doing things. We are designing portfolios to react to this current market environment, and we're seeing them perform the way we built them to perform.
So how's this impact you? Well, that's high inflation pressures consumers and portfolios, right?
Mm-hmm.
The market breadth, it's still narrow. We're still within a trading range that we saw since right before the election.
Yeah.
And
We've talked about in the past the large caps and the small caps kind of we need them to converge. And unfortunately, with this downturn, we've seen them both go down by equal measures, which does not help with our market breadth question. We'd love to see the small caps not be as declining as the large caps, but Right now, that's not happening, and that's okay. We'll expect that to happen sometime in the future.
We want to make sure that we maintain a long-term view towards the markets and the economy. Our economy is strong. There are some road, not speed bumps, if you will, along
Hmm.
the way that we'll face here. But I do think in the long run, this will make America's economy stronger, more competitive, and markets will return to be strong as well.
I
This
hate
is
to
a
break
temporary thing.
I hate to break it to you. If you're a long-term investor, unless you're planning on spending your entire portfolio in the next 3 to 12 months, then you should not worry about the current situation.
Right. And I mean, when spend all of it, right? Because
Yeah, every penny of it.
sometimes we have that finish line view in mind that, okay, I've retired, therefore I have to go hide under all my investments under a rock. And that's not the case. We talked about the inflationary pressures and the impact on cash. That's really the worst place to hide in the long-term view for your investments and things. But make sure you talk to your advisor. If you haven't had a conversation with your advisor lately, you can give us a call.
Hmm.
Um,
Ask
number,
them why and how they are designing your portfolio specifically to react in moments like we're in right
yeah,
now.
and different market environments and things. Don't panic. That's always important.
That hasn't changed.
And don't make decisions based on headlines. Oh my goodness. The headlines are our worst enemy. And we oftentimes will, we read a headline, it's like, oh, it catches our attention. It's clickbait, right?
Hmm.
It's a clickbait, catches our attention. We read the article, and it's like, that has nothing to do at all with this headline.
Right.
So don't fall for the trap. Of bad news is bad news is bad news, and we don't want to fall into that particular trap. So
We still maintain a very bright outlook. Even if we're not saying this is going to happen, even if we were to enter into a recession, even if
recessions are when the markets usually take off.
yeah,
If you look historically at those things, the markets typically take off
we
during
have we
recessions.
have a positive outlook. There are good things happening in the markets. Today's just one of those days.
Now, what about your 401k? If you're asking about my 401k, what do I do? Well, if you're not participating in our service to help you reallocate and allocate and balance your funds in the right way, you need to give us a call. That is available to any of our clients that still has a 401k at work. We can help you with that. Don't count on the 401k plan managed money solution that they often charge you for to give you the right idea. They are going to buy and hold forever. And most 401k plans are just full.
Hmm.
The preponderance of all the funds in there are large cap funds, which have seen the most damage this quarter.
Yeah, and in fact, with the recent volatility, our clients participating in the 401k program got a message and say, "Hey, markets are changing a little bit. We recommend that you do these things."
Right.
We saw it
And
work.
so it's a tool we use with our folks that have 401k plans that want to participate and sign up for that. Kind of helps you understand all your options and provides kind of a stop loss trigger
Hmm.
in the case of dramatic volatility. This today is in the markets is significant, right? It is significant. We're not trying to dismiss that. It is not cataclysmic.
Hmm.
And we've seen these many times before when there's uncertainty, and that uncertainty should resolve into more definitive plans for the economy and the trade and things like that.
Right.
Okay.
Here's a nice springtime picture for
Yes, bluebonnets are blooming now. They're
blue
not as
bonnets are
tall
popping
as I
up.
thought they would be, but
Nothing like last year.
yeah,
The grass is starting to turn green. But, anyways, we finished the first quarter of the year. And what does this mean for your financial plan? The same thing that we have been saying for a while. Don't be afraid to check your statements. Um, Maybe keep in mind what happened today if you do look at your statements today. But talk to your financial planner, professional, and educate yourself. Make sure you understand what's going on right now in the markets. You don't have to be a PhD economist, but just get a good view of what's going on, and that can really help you feel confident in your personal plan.
I'm reminding of a Marine friend and I'm paraphrasing him for a little bit more germane for our audience, but his thing was financial planning. It means that you're preparing for the unexpected.
Mhm.
That's why you plan, folks. You prepare for the unexpected so that your long-term strategy has not changed, right?
Mhm.
You may adapt to this situation on the ground, and you should be looking at that, talking to your financial professional and educating yourself, but you should not be making drastic changes that really can impact you negatively for the long haul. I still run into people, Jesse, from 2008 and 9 who are still
They're
holding
still scared.
cash and they're too scared to get into it. I understand it's scary. It's very emotional to turn on television. You know, the best thing you can do, turn it off. Don't listen to the silly talk shows that are on television because number one, they don't know anything about markets or the economy. But number two, they're just trying to stir you up and stir your emotions. So
We had a client
be wary
take
of that.
genuine financial advice from a well-known, highly politicized actress.
Actress, yes, yes. So we don't do that. Don't do that. If you have questions, you can text us. Let me get over here and get that next one, Jesse, if you don't mind.
Yeah, so here, once again, the text line is 254-282-0495. There's our 800 numbers. That'll get you to our office during office hours if you're interested. There's even an access to Mark's calendar. A little dangerous to give that to anybody.
Anybody can access my calendar? That's crazy. We better be careful with
If
that.
you want to chat with us, click that or visit that link, and we'd be happy to talk to you.
Hey, check out our website, clearvistafinancial.com. We've got links to future webinars. We also have links to our YouTube page with all our podcasts and things that you can access. The Spend Life Well Show. And we talk about a number of these topics every few weeks or so. So check in with us, see what we've been talking about lately, and of course, send your questions. Folks, we thank you for listening today. You can always reach out to our office at these contact points and things, but we appreciate your time. Have a great month.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in the show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.